Hey everybody, it's Michael Valtos, founder and trader at orderflows.com, and today I got a special video for you. It's 15 questions and answers on order flow trading. Now these are questions that people have written to me in the past, either posting them online or, on my YouTube channel or whatever. I try to get back to everybody. Sometimes I'm a bit slow. Sometimes unfortunately I do miss emails. I get a boatload of emails, and probably about 90% of them are spam, but I try to get to the emails when I can. And these are general questions about trading, not just on order flow and the order flow software, but on trading, with order flow in general. So I hope that you guys will watch this video and have some of your questions answered. Now I realize some of these questions people probably never even thought of, in your trading and how it can affect your trading. So hopefully you can learn one or two little tidbits in this video. So before I get started, brief disclaimer: this presentation is for educational and informational purposes only. Is not considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. And again, another disclaimer I think people should be aware of is, one of the reasons why results vary a lot is because, it really depends on the individual. If you as an individual, as a trader, are taking the steps to follow, what is being taught, whether it's by me or whether it's by somebody else, that's going to have an impact on your trading results. So, you could go take a seminar with somebody, pay $3,000, $5,000 for a week, and, sit next to the person, and the person just literally transfers every bit of knowledge that he has to you. It's up to you to put it into action, okay? That's what's your success or failure is going to fall on. It's going to fall on you. I know people like to blame others for their lack of success in life, actually, but it doesn't come down to it. It comes down to what you as an individual can do. I've worked in the professional world for 20 years, right? And I mean that's not a lot. I know people have worked there for 50 years, 60 years, but still, the point is, you can see how when the new people come into the office, who's going to be successful, who's not going to be successful, who's just going to be your average employee. It's the ones that take it upon themselves to want to learn more, understand more, know how things work, rather than just sort of come in, punch the clock, do your 8 hours, go home like that. There's a difference, right? It's what you as an individual do, and that spills over into trading, into your relationship, your everyday life. So anyway, I'll get off the soapbox there. First question. These are not in any particular order of importance. These are just, I just been writing down questions, out of my notebook, and I flipping through it, and then I took 15 today. So number one is, what kind of charts do you use? Do you use minute-based charts, range-based charts, renko-based, etc.? I used to use minute-based charts. Now I use range-based charts, and the reason why I use range-based charts is because I like to see how price moves in relation to the market. I don't want a bar to close because, oh, it's 9:30 and I'm using a 5-minute chart, and it's 9:30, so I got to close this bar, open a new one, like that. I want to see how price rotates around the auction, and whether if the price is moving up or price is moving down. I want a new bar to form as price is moving up, rather than, hey, oh, it's 10:37. Okay, I'm using a 1-minute chart. It's time for a new bar. No, I don't think it's as useful in trading as, say, a range-based charts. Now, renko-based charts. There's so many different types of renko-based charts now. I've tried renko-based charts, honestly, and to me it didn't really make that big a difference in my trading versus a range-based charts. Now again, there's these other types of uni renko, this renko, that renko, and people do send me charts, and often I'd say about a third of the charts that traders in my software send me are renko-based charts, asking me to comment on their analysis. And so I know there are a lot of people out there using them, and some people are quite successful using them, although honestly I've never met a professional trader at JP Morgan or Cargill or any of these other companies looking at a renko-based chart. But that said, most of those traders are more long-term based chart traders, not necessarily intraday trading. They're more of swing traders at a minimum and more of a long-term traders. And the other base chart is, I'd probably say like a tick chart. I do use tick charts. I do look at like 987 tick charts. 987 is a fib number. In some markets, I use as little as 100 tick chart. Now, I do use minute-based charts on a few occasions. I do keep 15-minute charts open, and I keep a 1-minute chart open in E-minis. E-minis just trades a boatload of volume in a very short period of time. So, I like to look at it, but I don't really use it that much. The majority of my trading, 95% of my trading is range-based charts. Number 2, what's the best time frame for trading order flow? Well, that sort of goes back to the first question, what kind of charts I use. I use range-based charts, and on a range-based chart, it can take 30 minutes for a bar to form, and so it's hard to say in that sense. Now, intraday trading is suited for order flow. I mean, it's not something you're going to look at, 3 days ago information. With order flow, you want the most recent information. So, intraday trading is, for order flow. I get people that for some reason, they're swing traders, and for some reason they want to try order flow, but they're holding their positions for like 3 days. And I tell them, well, order flow is not suited for that. So, based on how I trade and how I teach order flow. So, intraday time frames are best for order flow. I'm not going to say, on a 5-minute chart or a 1-minute chart. I know people that use it on minute-based charts, 1-minute charts. I know people that trade with 3-minute charts. I know people that trade with 5-minute charts. Really, about as far out as you'd go, I think, is about a 10-minute chart. Question number 3, why do I use a 10 range and a 4 range E-mini chart? Now, okay, so, an important part of trading is having a chart that you're comfortable with trading. Okay, I use mostly 4 range charts for nearly every contract out there that's a slow moving contract. By slow moving, I mean, things that, trade a lot of volume, and, it's going to need a head of steam to make a move. So, for example, bonds, 5 years, 10 years, bunds, Euro stocks, E-mini S&Ps. I use 4 range charts. Soybeans, I use 4 range charts. Corn, I use 4 range charts. I use a 10 range chart for E-minis as well. And the reason being is there's days when the market is slow, and there's days when the market's got a lot of volatility, like Monday, and even last week. I think it was last Friday, right? You had like a 40-point range, 30-point range. A 10 range chart is going to be a lot more useful on a day that is very volatile than a 4 range chart. A 4 range chart in the E-minis is something I would use when the market is calm, and there's no numbers coming out, and it's just sort of rotating around value. But a 10 range, on a market that has a lot of volatility, I like to use wider range charts. Now, I use 8 range charts for Euro currencies, Japanese yen, crude oil, NASDAQ. NASDAQ, I think I got to bust out to a 10 range chart. I don't like to go beyond 10 range. I find 10 range is about as wide a range as I'm comfortable with using on a chart. Even Hang Seng, I'll use a 10 range chart. DAX, I use 8 range actually. Now, what platform does Orderflows Trader run on? It runs on NinjaTrader 7, NinjaTrader 8, and we have a Sierra Charts version. Sierra Charts is with another partner of mine, and if you're interested in it, just let me know. I'll give you the information on that. But as far as NinjaTrader, which version do I think is better? Well, I think NinjaTrader 7 is better. NinjaTrader 8, NinjaTrader is really making that push to get people out. It's taken them 3 years to get NinjaTrader 8 out. And last year they just released it, like right around Thanksgiving, when earlier in the year is when they were really planning on releasing it. And at some point they're going to stop. I'll say at some point, realistically they're going to stop supporting NinjaTrader 7. And when is that? I don't know. Sometimes these guys with NinjaTrader, you send them, even when they're doing all that testing for NinjaTrader 8, like myself, my programmer, other people I know would send in our issues with NinjaTrader 8. And they would just say, oh, well, it's still in beta. It's like, well, you're asking us to send in our issues, and you know, the way you put it off is like, you don't really care about it. It's like, well, why are you asking for our feedback? But, you know, it runs on NinjaTrader 7. I know people that I use a NinjaTrader 7. I'm probably going to make the switch to NinjaTrader 8 pretty soon. It's just a matter of one or two issues that I have. I use it in the trading room, NinjaTrader 7. But NinjaTrader 8 handles data much more efficiently than NinjaTrader 7. So, you know, NinjaTrader 8 is obviously the future with NinjaTrader. Ratios. You hear me talking about in my videos ratios. Now, ratios are order flow analysis put into a numerical format. Again, it's not some big mathematical equation. Basically, it takes the order flow in a bar and, you know, just puts it into a number and spits it out. And, you know, there's certain numbers that I find, you know, when it's above a certain level or below a certain level that I find interesting. You know, most of the time, 90% of the time, you're just going to get your average order flow. You're not going to get any special number, any special ratio. But really, you know, a ratio, when you're dealing with the order flow, you deal a lot with ratios, even in imbalances, right? A buying imbalance is when, you know, volume traded on the offer versus what's traded on the bid is above a certain ratio. You know, 4-to-1 usually is the industry standard. And, you know, that's, you know, another form of ratios in order flow. But, you know, order flow, you're comparing what's happening in volume, right? Because order flow revolves a lot around volume. What is point of control? POC. POC in a bar, in this case, in order flow, is the point of control in a bar, the level with most volume traded. Okay, and usually it's highlighted with a black rectangle around it. It's pretty clear once you look at an order flow footprint chart. I don't have charts in this presentation. Explain trap traders, number 7. You know, trap traders is a term. I don't really like the term, but you hear it a lot. I use it actually sometimes in my videos. But you know what trap traders are? It's people that are basically long and wrong, or the opposite. You know, they're caught short and the market's rallying. And you know, these guys are, you know, usually they're day traders that, you know, or even to a lesser extent scalpers that, you know, they're buying at a level, at a high, thinking the market's going higher. So the market turns around and all of a sudden they're sellers because they don't want to be riding a big losing position. They just get out, they're trapped, they realize it, and they get out, and it shows up in the order flow. But let me just explain why I don't like the term trap traders. Is because, you know, it's very misleading. And, you know, I mean, there's enough liquidity in pretty much every single market, even in these less liquid markets. And trust me, I trade some very illiquid markets like palm oil that, you know, you can get out. You can get out. You know, it's unless the market goes limit up or limit down, you can get out. It's just, you know, how much pain you want to take before you get out. So, you know, when you think of trap traders, you're thinking of people, oh, they can't get out. You know, they're stuck. And you know, where are they going to get out? No, I mean, it's just a matter of pulling the trigger. And, you know, I think it's sort of, you know, when you think of trap traders, you know, we like to think of retail traders, the people that lose a lot. And, you know, I put myself in, I'm a retail trader. I mean, I hate to use the term, you know, I'm a professional retail trader. Oh, bullshit. You know, everybody that's, you know, unless you're trading for a bank or you know, a fund or, you know, commodity house, you're a retail trader. You know, there's big retail traders, but, you know, the reality is, you know, I'm a retail trader. I don't try to put myself out as being, I'm a professional trader, even though, you know, trading is what I do to pay the bills and all that. It's, you know, I'm still a retail trader in that sense. Now, you know, so when you think of trap traders, really you think of, you know, these guys, retail traders that often show up late to the party. You know, the market's rallying, they come in, they start buying, and buying at the high, the market is going higher, starts selling off, and, you know, they get out, you know, way much lower. Whereas, you know, when you think of scalpers, you know, scalpers, they're trying to buy the breakout at a high, realize they're wrong really quick and get out very fast. They're, you know, that's the difference between a scalper and a retail trader. Is, you know, a scalper is willing to cut his loss without even thinking about it. You know, he realizes he's wrong and, you know, he just cuts it. You know, that's the difference between a good scalper and, you know, retail trader. Most people, you know, most retail traders don't have that in them. You know, it's sort of a trait that takes a lot of time to get, you know, and not everybody's just going to come to trading and have that ability to cut a loss really quick like that. Number 8, what's the difference between a volume footprint chart and a DOM? Well, a DOM, depth of market, volume footprint chart is what actually traded. And volume footprint chart shows the volume traded on the bid, shows the volume traded in the offer. A DOM shows what's on the bid, what's below the bid, what's on the offer, what's above the offer, and shows people, layering in their bids and offers, pulling them, playing their games. And for me, the big difference is commitment versus intent. A DOM shows someone's intent. A volume footprint chart shows someone's commitment. When you're on it, when you have a position on, you're committed to the market. At some point, you're going to want to get out. I mean, now people say, no, not everybody gets out. Yeah, okay, I do understand. People take things to delivery. I've taken things to delivery when I was at Cargill, and that portion of the market is so small. It's so small that it's not even a question. And nowadays, you got a lot of people hedging stuff, versus Delta One, desks, things like that. Now, yeah, but the majority of trading is someone gets in a position, they're going to get out, whether it's today, tomorrow, a week from now, 2 weeks from now. 90% of the volume that's traded is eventually someone's going to get out of it. Now, a DOM, again, is just people showing their intention. If the market is 6 bid at 7, all of a sudden a lot of, a big bid comes in at 5 below the market or at 4, people get scared. Honestly, these DOM traders, they think, oh, I should, we're trading 6 bid at 7, someone's putting a bid to buy 1,000 at 5. Well, the market's 6 bid, right? Honestly, if the market's 6 bid and you can buy at 5, then you're in the money, right? But you're not going to trade 5s until the 6s go. So I understand all the games people play with DOMs. I used to play these games with DOMs, and I just find for trading purposes it's better to make decisions based on what actually traded versus what someone's intention is, right? It's how to put it in everyday terms. Okay, think of it like dating, right? There's a lot of pretty girls. You go to a bar, a lot of pretty girls out there, and you're sitting there with your buddies saying, oh, I'm going to ask that girl out. Yeah, then, we're going to live happily ever after. I'll have 3 kids. Well, unless you actually get up off your butt and ask the girl out, you're not committed to the relationship. If you're just there talking about it, you're just there scouting the room out saying, oh, yeah, that girl looks nice, that girl looks nice. That's like looking at the DOM. Whereas once you ask the person out, set up the date to have dinner and so on, then, you're committed to that position, so to speak. On a DOM, you're not. You're just sitting there scouting, oh, maybe I should do this, maybe I should do that. And that's the difference. What are the best markets to trade? Okay, well, again, I'm a futures guy, right? And, my background is on futures. So pretty much any futures market you can trade. I've looked at literally just about every conceivable futures market in the world. I've traded South African white maize. I've traded Tocom rubber, Azuki red beans. A lot of these very, very small markets. And, believe it or not, order flow actually works on them to the extent that, not everything is going to work because, some analysis you need a little bit more volume, but, supply and demand is what drives the market, right? And how can you tell what supply and demand is? It's based on what's traded. Does it work with Forex? Not really. I mean, the problem I have with Forex, and I got into arguments with people, and some people are just downright nasty, because, maybe they think they're a Forex god or something. They're out there trading their, their little micro account, where 1 pip is 10 cents or something, and they think Forex is the greatest thing. But the data on Forex is crap, You've got every different Forex dealer out there basically with their own feed. So, and then where you get your data feed to run through your charts oftentimes is through someone else. So, it's I don't know. They just don't understand how the Forex market works, And, some people, it's like my wife, honestly, I speak softly so she doesn't hear it, is, she just learned how to drive a few years ago. And, I've been driving since I was 16 years old, so I've been driving for about 30 years. She's been driving for 2 years. Yet she's there telling me how to drive. Oh, don't get in this lane. Stay over there. Go over there. Don't get behind this car. I'm just like, would you be quiet? And, and sometimes you get these guys that, these Forex guys, again, and I'm sure I want to get a lot of nasty comments about this. I mean, what Forex is a good market. I've traded Forex, but, the ideal market to trade order flow is on futures market, markets that have centralized data, even stocks. I mean, can you trade stocks? Yeah, there's certain things in stocks that I look for in order flow. But ideally, the best form is going to be in futures that have centralized data. You got all these dark pools in the equities markets. Forex, if you're trading through a white label, through some broker, you don't know where the data is coming from. And the data you could be looking on your screen is going to be different than the bid offer in there. And the other thing is, everyone says, well, Forex is great because you don't have commissions. Well, yeah, but you're giving it the edge. You can't work a bid, you can't work an offer. You got to basically buy the offer or sell the bid. So that's a big difference. Again, I'm not a Forex guy. I've traded Forex, don't get me wrong, but I just find for trading purposes, futures is a terrific vehicle. They've been around for hundreds of years. Is order flow easy to use? Number 10, is order flow easy to use? Well, once you understand it, yeah, it's great. Once you start looking at order flow chart, you'll never want to look at another bar chart. I mean, you will, but for trading decisions, you'll feel like you're not getting the complete picture of what's going on. And is order flow easy to use? Yes, it is, because once you understand what's going on in the market, your trading decisions basically become second nature. You're going to be making these decisions, automatically. You're going to be anticipating. You're going to see the market unfolding before your eyes, and you'll be able to anticipate what's going on in the market, where it should go. Okay, if this bar is going to end up like this, I think the market should go this way. And, you're going to be not trying to predict the future, but you're going to be basing your analysis on what's just happened, because, these things repeat themselves, not exactly, picture perfect repeat, but, you see what's happening over and over and over, and you can anticipate basically what's going to happen next. If A, B, C, D happened, E, F, G generally is going to happen. It's not going to be A, B, C, D happen, then Q, Z, U, X happen. It tends to follow in order. Number 11. And, just sort of going back on that, is it easy to use? Once you understand it, you internalize it, right? It's like learning to drive, right? You learn how to drive at an early age. I'll say early age, in your teens, you learn how to drive. And, as you get more experience driving, you internalize the whole driving experience. And, so you know what's going to happen. I say not know what's going to happen, rather, when you're driving down the street, all of a sudden a dog jumps out. You know how to react. You don't have to sit there and flip through, oh my God, what do I got to do? A dog's jumping out, or, a car swerves in front of you. You know what to do. If you're driving in the rain, you know what to do. If you're driving, hit a patch of ice, you start skidding, generally you know what to do. And, that's part of internalizing the market. And once you internalize order flow, it really becomes super easy. And again, it's not going to take you 10,000 hours of screen time. It should take you a while to learn. It depends. Again, I can't say it's going to take somebody 2 weeks and it's going to take someone 2 years. It really depends on how much time you have to devote to it, and how open you are to the ideas and concepts. Some people have a very closed mind and they come into it, and they don't want to expand their mind, so to speak. But if you do, then it's going to be very, very easy to use very quickly. So again, number 11, is order flow just the latest fad in the trading world? Well, it's not. Actually, order flow has been around much longer than, technical indicators. Maybe the only thing that hasn't been around that's been around longer than order flow is probably candlesticks. Candlesticks trace their history back, to the 1700s, back to Japan when people were trading rice. But, order flow goes back at least 100 years, goes back to, the tape readers. Tape reading is order flow. And, if you've ever read Reminiscence of Stock Operator, the guy was a tape reader. Basically, he's an order flow trader. And, so you see these people on these message boards that, don't trade or trade in their sim account saying, oh, order flow is just the latest fad. It's not. Maybe the way it's formatted now, it looks like a fad or the latest thing in the trading world. But, the whole thing of reading the order flow in the market has been around for 100 years, and it's going to stay there, right? It's not going anywhere. And what's happening is now with the advent of computers, it's taking the data, more data is available that wasn't available before, for one thing, and two, computers are putting it into a more digestible format that makes reading the order flow a lot easier. So again, you're just taking the same data that's out there. It's not like taking some fancy data. It's taking the volume traded on the bid, the volume traded on the offer, putting it on a nice, easy to read chart. That's not doing anything, super fancy. It's not taking numbers and out of its thin air and creating them. No, it's taking the numbers, the information, the data that's available, data that the exchange puts out. In the past, right, when there was a trading floor, traders that traded on the floor, they had access to order flow in the terms of they could see the orders coming into the market. Sharp locals would sit there. They would watch. They'd watch the big desks, Solomon Brothers, Goldman Sachs, Smith Barney, Northern Trust. All these firms that had big traders trading, in that particular market, and they would see, okay, the clerk picked up the phone. He's going to start looking. Let's check out the bid offer. Maybe start flashing in some orders. They know that, the person on the other end of that phone is a big trader generally, and if all of a sudden the big, the clerk is waving, trying to get the pit broker's attention, and he watches, he sees the guy start signaling, hey, buy, touching his head, with his fist closed, buy 100, then the guy's going to be in the pit buying as much as he can before that order can hit the pit. That's why exchange memberships cost so much before, is because people, they would have that edge, in a sense they could see the order flow coming in as it's coming in, and actually they were able to see it and react to it before it hits the market. In some of these markets, there would be big traders, right? They would know that, okay, that Tudor would trade through X broker, and and at certain times of the day, a certain hedge fund would call up to balance their fund at a certain time, at 3 o'clock. So if all of a sudden they see Commerzbank is starting to buy S&Ps at 3:45, there's a good chance they're going to be buying it for the next 15-20 minutes. And so that information was available to pit traders where it wasn't available necessarily to the rest of the world. And now with computers, it's more anonymous, but if you could read the bid offer and what's going on, and make heads or tails of it, which is what I try to do. I try to show people, whether or not you believe me or not is up to you. I don't give a shit. I know people don't take the order flow because they can't wrap their head around it and they don't want to believe in it. But whatever. There's so many different ways to approach the markets. This is how I approach the markets. This is what I've done for 20 years. At very high levels. I said, I'm not trying to brag, but you don't last that long at a trading firm for years. 8 years at JP Morgan, unless you know what you're doing, and you can read the market, and you're basically making money for the firm. So is it a fad? No, it's not. It's understanding the market basically is what's going on. Number 12, I want to make money trading. Will order flow help me? Yes, it will. But again, it's up to you to take that step and learn it, right? I said I could sit here and I could every day, I put out, well, not every day, I put out videos, trade recap videos, and sometimes I talk about the same thing every single day. I say, okay, here's your ratio and a divergence, and the market sold off from a high right down to the low. The next day, ratio with divergence, market sold off from the high right down to the low. I don't know what else I got to do to convince you that ratios with divergence is a good setup. But some people, well, I don't want to take it. Okay, well, I can't help you. It's not going to help you unless you let me help you. And so again, you could make money trading, but again, it comes down to you as a trader. Are you willing to take that step? I know some people are scared. Money's involved. Hell, I'm scared sometimes when I've got a position on and it's going against me. I'll be honest. I'm not like Val Kilmer in Top Gun. Iceman, where I've got no fear. But the problem I have with that character is he doesn't like the Tom Cruise character because he says he's dangerous. Well, if you're Iceman, you shouldn't be afraid. But anyway, it's one of those things where yeah, I can only help you to a certain extent, but then you still got to go the next few steps after that, right? I mean, it's you that's got to click the buy button, click the sell button. It's up to you to still take the trades. I could show you on the map where to go, but if you're not gonna go in that direction, then I can't help you. Again, real life example. Every day my wife asks, "What do you want to eat for dinner?" Well, I want to eat this. I don't want to eat that. Well, then, why are you asking me what I want to eat? And it's the same thing with trading. Can you make money trading? Yeah, you can. I think if you follow order flow, looking for these setups, yeah, you can make money. Well, I don't want to do that. Well, okay, then why are you coming to me? Why do you want me to help you if you don't want to take the steps that I'm trying to show you? What is market generated information? Yeah, again, it's a term I use a lot. People say, why do you use that term, market generated information? Well, all information that you see on a chart comes from the market. Yeah, I know that. But when you're looking at an order flow footprint chart, right, you see what's happening in real time, like literally down to the tick. Now again, I'm not a dome-based trader, right? I'm a footprint-based trader. Dome-based traders is really like living and dying by every tick. Footprint chart is sort of a step back, and you're basically you're looking for certain setups that is just literally as the market is generating this information right now, right here. You're basically making your trading decision based off it. When you use like say something like MACD or a moving average, you're using a lot of information that is stale already, whereas you're using market generated information, right? If you're familiar with what an imbalance is in the order flow, it sounds a bit like Star Wars there, an imbalance in the flow, imbalance in the force. But when an imbalance, as soon as you see an imbalance coming in, that's market generated information that you can use that very few people have access to, or don't say have access, everyone has access to it if they're willing to get a footprint chart up on their screen, but most people don't. Knowing where the point of control is in a bar, that's market generated information and how it's in relationship to a high or a low. That's market generated information is information that's generated right now that you're basing your trading decision based off of. If you're using VWAP, VWAP is volume weighted average price, right? It takes a long period of, let's say a long period, but a certain period of time to form a number, right? That's technically that's market generated information, but that's not what I'm talking about, or based on the last couple of trades. That's really market generated information to me. Most up-to-date information that I guess I'd put it as most up-to-date information generated from the market. So if you're such a good trader, why are you selling this? Why are you teaching people? Why don't you just go on an island and trade for yourself? I've thought about that actually, and I've done that. But I said, I spent 20 years working in various firms, and I do kind of miss working with, communicating with other traders. I'm now at the point where I sort of have a nice little network of people that I communicate with on a fairly regular basis, but and as a trader, right, again, I could put this stuff out for free. No one would probably listen to me. I sell it, people still probably don't listen to me, but it's one of those things where it's, again, why do I sell it if I'm such a good trader and I just don't live off the trading money? Well, honestly, I'm at that point where do I really want to keep doing this? Yeah, I do, because I like working with people. I like when people write to me and say, you know what, Mike, I found you, searching on the internet. I've watched your videos. I've dissected them. I say, I have over 150 videos up on YouTube, and I put out a trading course. People just say, I've watched your videos, and I've picked up a few things. I've applied it to my trading, and I'm finding myself being a little bit more consistent. I'm having more days of making money than losing money. And they just they thank me, and as a person, that makes me feel good, right? I've never wanted to be a teacher in school. I hated school, but now I don't mind working with people that want to learn, right? And honestly, I got to put a price on it. I can't just give it all for free. It takes time. I got to buy certain things. Microphone, a stand, things like that. It's not a big moneymaker in that sense. It just sort of covers the costs, and at the same time, I get to meet people, work with people that want to trade. I still trade. I've got accounts at several brokers, and so it's not like I'm doing this instead of trading. Honestly though, when I get the hate mail, I do think of just giving it up. So why do I bother? These people are killing me. Um, they think that they own me now just because they bought my software. But again, I don't want to discourage people. But again, it's up to you as a trader to become successful. I can only take you so far. That you have to take some responsibility for your life in general as well. Again, I said, I could teach you the setups, and I do teach people the setups. I say, here, look for these 3 things in the market. That's all you got to do. I think you could survive on just one of them, but I give you, often 3 or 4 different things you could look at. I just say, just look for that. Don't look for anything else. Don't try and get confused on anything. Don't try to put everything together at once. That's where a lot of people lose sight of what's going on, is they oftentimes try to put everything together. I cover a lot of ground in my trading course, right? It's 20 lessons in my trading, about 18, first one and the last, first one is sort of an introduction, order flow. Last one is, or the last 2 is, sort of like a recap and just sort of putting it together. But again, I cover, so there's about 16 or 17 lessons in there. Different things, and oftentimes everyone, people I find that struggle a bit, they try to put every single thing together at the same time. No, look for 1 or 2 things. Concentrate on imbalances, concentrate on ratios, concentrate on point of controls, understand that inside and out, then you can move on to the next point. But when people are putting it all together at once, they're often putting it together, incorrectly. Like I've got kids, and they make a mess. And sometimes I'm just it's very late at night, and it's messy, and my wife's a bit OC, obsessive compulsive, and if the house is not clean, she can't sleep. So I'll help her. My kid's got about 50 toy cars. I'll just sort of round them up and put them in a corner, and because I just want to get to sleep also. But oh no, it can't be that. It's got to be all exact in order. Well, what do you want to do? Do you want to sleep, or do you want to make sure the cars are color coordinated before you can sleep? Me, I say, I just want to make sure it's all tidy, good, then I'll go to sleep, but, and there are people like that where, they can't take a trade or, do a trade unless they think everything is perfect, aligned up. Well, you know what? The market is not going to be perfect, right? It's not going to be exactly the same every single time. Things are going to be a little bit different. I talk about ratios with divergences. If you don't have a ratio in the bar, you have divergence, look to the next bar. And sometimes there's another bar in between the two, which, sort of, messes the whole setup up. But again, market is constantly trading, so one example is not going to look exactly the same to the numbers as the previous example. So again, at the end of the day, it comes down to the individual person. Do you want to be successful or not? Again, that decision's up to you. Aggressive buyers and sellers, what are they? Well, okay, so first of all, when back in the old days, when I was at these firms, you call it, why is the market moving? Well, there's more buyers than sellers. No, there's not. What you have actually is more aggressive buyers than sellers, or more aggressive sellers than buyers if the market's selling off. And it's a zero-sum game. Okay, for every buyer there's a seller, but there are times when there are aggressive buyers, more aggressive buyers than sellers. When the market's moving up, or when the market's moving down, you have more aggressive sellers than buyers. And again, that shows up in the order flow. I mean, that's central to order flow analysis, basically. And by determining what the difference is, when aggressive buyers are showing their hand, or sellers, you can, that's where your profits are going to come. And order flow makes it easy to see that. Now, there's 4 types of buyers and sellers. Okay, you have aggressive buyers, you have aggressive sellers. Basically, people that buy at the market or sell at the market, they're being aggressive, right? The market is 6 bid at 7, and someone buys 7s, they are an aggressive buyer. If someone sells 6s, they're an aggressive seller. Now, okay, but then, well, who's on bid at 6? Who's on the offer at 7? Well, those are passive buyers and passive sellers. They're people working limit orders, waiting for the market to come to them. Whether they get filled or not, I don't want to say they don't care, but they're willing to take that chance that they don't get filled. They're a passive buyer. If the market's 6 bid at 7, you could buy 6s and sell 7 all day. You're going to be a passive buyer or a passive seller, right? So if you're on the bid at 6, you're a passive buyer. Someone sells into your bid, fills you. That person that sold you at this, sold it to you at 6 is the aggressive seller. The best way to think of it is when you go to buy a car. Okay. Say, I was looking at, what was I looking at? Chevy Suburbans, about $40,000, $50,000 a car, right? Depending on your setup. And, for example, you think your budget is, $42,000, okay? And you go to the dealership and in your mind, you're willing to pay $42,000 for that car, but you go to the dealer, see the car you like. Okay, you ask the salesman, how much is the car? Oh, it's $50,000. Okay, so he's happy to sell it to you at $50,000. You're happy to buy it at $42,000. Well, no trade's going to occur because you guys are too far away from each other. A trade will occur if the seller, the car dealership, gets aggressive and sells it to you at your bid. So now you're willing to pay 42. He's at 50, and all of a sudden, nothing's happening. You're just there staring at each other. Now the car dealer is thinking, okay, shit, this guy's at 42. I don't want to sell it at 42, but I'll take a loss. And he'll be thinking, and next week I've got another 50 cars coming in, so I'm gonna be long cars, but I got a buyer here, but his price is too low. So what can I do? So all of a sudden the buyer is like thinking, well, I don't want to pay 50. That's too much. Maybe I could get him interested if I go up a little bit. So the buyer says, okay, I'll go up to 45. So now buyer's bid at 45 to buy the car. Dealer, okay, he's interested. So boom, seller goes down and hits the bid at 45. And so the seller's the aggressive one. Now, I know people are going to say, no, well, the guy went up on his bid, but he still bid there, right? He's still taking that chance of not getting filled. The aggressive seller, the car dealer, wants to sell that car. He wants to sell it now. Boom, he hits the bid at 45. Okay, so at the same time, the car dealer could say, no, I'm stuck at 50. I can't sell for less than 50. Then the buyer would have to pay 50 if he really wants the car. Otherwise, he's not going to get the car. And then in that case, if the buyer paid $50,000 for the car, he would be the aggressive buyer. The car dealer would be the passive seller. So that's the difference between aggressive buyers and aggressive sellers. And passive buyers and passive sellers. If you want to get into the position now, generally you're going to be aggressive. And there's times when the people think the market's going to really start moving, that they're going to get aggressive and get active. You can't participate in a move unless you get into it. And oftentimes you got to be aggressive to get into a move. That doesn't mean every single time you got to be aggressive. People get into markets working bids and offers. I do it. But you also take the chance of not getting in. But if you want to get in, you're going to be aggressive, right? And generally you'll transact at the market price. Okay, so that's 15 questions that I get asked quite often. I'll try to do these videos. I like doing this stuff. It gives me a chance to talk about other things than trade recaps, and I find it quite refreshing, actually. So again, thanks for watching this video. Subscribe to my YouTube channel. I try to put out videos fairly regularly, time permitting, and I try to share as much as I can with people. And if you want to take your education further, visit my website, orderflows.com. I've got a trading course. I've got an inner circle. I've got I've got software. So there's a lot of different ways you could learn order flow. You could learn for free, based on the things that I teach you in these videos. Or if you want to speed it up and really accelerate your learning, then take the plunge, right? Become a member of orderflows.com. So thanks everyone, and hope to hear from you. Bye bye.